Hello, I'm Sam Vernier.
Hi, I'm Connor Woods.
And I'm Nick Quinn. We are the analyst team here at howtotrade.com. And together we're going to show you everything that you need to know about trading the bull flag pattern. So let's get started. A bull flag is a continuation pattern that signals the uptrend the market is currently in is about to continue moving higher. It's a very, very common pattern, and you'll get it on all different asset classes, and you'll get it on all different types of timeframes. What it's showing us is that the market is about to start moving higher. So you could use it as confirmation for looking to enter into the market on the long side, or alternatively, if you do have short positions in the market at that particular current time when that pattern is forming, you might want to use it as a cue to actually remove those shorts from the market. Let's break down exactly how we would identify it. Now, the bull flag is a very common chart pattern, and it gets its name because of its shape. It basically looks very much like a traditional flag. As a result, there's two components to that. We have the pole itself, and we have the actual shape of the flag as well. The pole comprises of our bullish trend. So that is our move. And then the flag component is the consolidation that comes afterwards. Now, the easiest way to think about identifying this is you use a couple of tools to draw it on correctly. The first thing that you need to do is you need to identify the actual trend that you're in. So we know currently we have a bullish trend that comprises our pole. And so you would draw that in as such, connecting the bottom to the top. The second component is to use the trend tool to do that. The third part is to use the channel tool to define the actual flag itself. So you would use that across the top and the bottom of the consolidation. Now, the flag itself can be angled horizontally, or it can have a slight lean to it. Both are very common and both trade in a similar sort of way. The next thing that you need to do is you would use a buy stop order to enter long in the market, and you'd always place that buy stop order above the actual trend line that you've created. And then conversely, what you would use is you would use your stop loss underneath the bottom part, underneath the bottom of that trend line. And that is the correct way to properly identify a bull flag.
So then let's look at how to trade these on the chart. Before we get started, it's important to emphasize that bull flag patterns apply to uptrends. So we're going to want to be focusing on the buy or the long side of the market. And there's two ways you can trade these bullish flag patterns. Number one is the breakout strategy, and this is what we see here. And before we do that, we need to identify the flag and the flagpole within this bullish uptrend. So as you can see, the market is trending up at the moment, and this initial move up is the flagpole of the market. And when we get that sort of consolidation period we have here, that's known as the flag, and you can really see the shape taking place here. Now, if we want to trade the breakout strategy, then we first need to actually look at where is the key breakout candle here. Now you can see as we've gone to move higher in this market, you can see this candle here is when we've broken above this flag level. So if we're looking at entries on the chart and we're entering a long position, we want to enter at sort of the closure of this breakout candle with a stop loss sitting just below the flag. Now we want to aim for sort of 1 to 1, 1 to 2, but you can see this particular trade actually managed to hit quite a significant 2.7, nearly 3 risk reward, and that's how we can trade the breakout bull flag pattern. Now, typically you may find the actual flag portion of this bullish flag pattern doesn't move perfectly horizontally. So what you'll see within this flag pattern we have here is frequent pullbacks. Now, in this case, we can use these pullbacks to buy the market and actually boost our risk reward ratios, because earlier on with the breakout strategy, we made around 2.7 to 1. This time with the pullback strategy, you can see how we can make a lot more. So within these pullbacks, you may want to use like a Fibonacci retracement, which coincides with the bullish flag pattern. So what you may want to do is draw this Fibonacci retracement from the base of the pole up towards the top of the flag. And when we get that, we can see these key levels starting to shape up. Now you can see this key 38.2% level of the Fibonacci. We could use those pullbacks to actually boost our risk reward. And by that, I mean entering a long position on the retest. You can see we retested this 1, 2, 3 within this bullish flag. So say we get on retest number 3 of this bullish flag pattern with a stop loss still sitting just below the base of the actual flag portion. And our stop loss then is a lot smaller, and actually we can target much greater risk reward. That 2.7 risk reward trade is now something like a 31 risk reward trade. So that's how we can use the pullback strategy to really boost our profitability.
Okay, let's take a look at a few of the key pros and cons for the bullish flag pattern. On the pros side of the ledger, the pattern is simple to identify. It's also prevalent on every time frame in the Forex. It's a reliable way of trading uptrends, and it furnishes traders with concrete market entry and exit points, so there's no guesswork on when and where to get out of the market. Now, on the con side of the ledger, the flag length is open for interpretation. There is a bit of nuance and discretion involved in identifying an ideal flag length. Secondly, it may conflict with other technical analysis tools, specifically reversal indicators. And lastly, trading volumes can be erratic in the live market, and this oftentimes can undermine market entry for the bullish flag pattern. Now, let's review some key takeaways from the bull flag pattern. Number one, the bullish flag pattern occurs frequently on every Forex time frame. It is the opposite of the bearish flag pattern. Number two, bullish flags signal the continuation of a preceding uptrend. Number three, the pattern may be used to buy bullish breakouts or trade the pullbacks of uptrends. Number four, other technical analysis tools can be used in conjunction with bull flags. One example is Fibonacci retracements. Now, if you want to learn more about the bullish flag pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you exactly how to fit the bull flag into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to practice and gain experience, and once you're ready, feel free to join our How to Trade Funded Trader program.